You hear that the financial world is holding together, inflation is easing, and the system is still intact. But here is the real story. Under the headlines, the world's financial system is under strain from four huge forces. They are not tiny cracks. They are the four horsemen of a global liquidity squeeze. And right now, they are already on the move. What you are about to see is how the global shift from funding new growth to rolling old debt could drive one of the most visible, yet still ignored financial strains of this era. Most people think a financial break hits like lightning. Fast, sudden, out of nowhere. This one is different. It started quietly when the role of the financial system began to change. For years, markets were there to fund new ideas, new firms, new factories, and new risk-taking. That is no longer the main job. Now the system is spending more and more of its energy refinancing what already exists. In plain English, the machine is no longer funding the future. It is busy carrying the past, and that is the weak spot. The whole structure now rests less on expansion and more on a fragile cycle of debt rollover. When liquidity dries up, that cycle stops. This is not some abstract issue for academics. This touches savings, jobs, asset prices, and the value of the collateral sitting under the whole system. And the four forces draining that liquidity are now right in front of us. The first horseman is the very force that used to keep the system easy: central banks. For more than a decade, institutions like the Federal Reserve flooded markets with liquidity. QE made money easy, pushed yields down, and gave the whole system a giant cushion. That era is over. Now those same institutions are moving the other way. They are shrinking balance sheets. They are pulling reserves out of the system. They are no longer adding slack. They are removing it. This is quantitative tightening, and the key thing to understand is this. Even when the market gets excited over rate cuts or pauses, balance sheet runoff can still keep draining liquidity in the background. That is where the strain begins. You can talk about policy rates all day, but the machinery underneath matters more. If central bank balance sheets are still shrinking, the system still has less room to move. That is not a small shift. It changes the whole backdrop. Because the world is trying to refinance a mountain of old debt. At the same time, the institutions that once supplied easy liquidity are stepping back. That is a bad mix. Central banks are stuck. They want to look credible on inflation. They do not want to look soft. They do not want to lose control. But every month that liquidity keeps draining, the pressure on a debt-heavy system grows. So this is not just a policy story. This is a liquidity story. And the first horseman is central bank reversal. The second horseman hits the financial plumbing itself. It sits inside the bond market, especially sovereign bonds like U.S. Treasuries. They are the collateral base for a huge share of the modern funding system. Banks, hedge funds, dealers, and large firms use them to raise short-term cash and repo. So when treasury markets are calm, collateral stays strong. Funding stays smooth. The system looks stable. But that only holds together as long as confidence holds. Once bond volatility rises, haircuts rise. Once haircuts rise, the usable value of collateral falls. Once collateral value falls, repo funding gets tighter. That is where trouble starts. And we have seen this movie before. Repo stress in 2019. The Treasury market dashed for cash in March 2020. The UK pension crisis in 2022. Silicon Valley Bank in 2023. Different headlines. Same underlying logic. Collateral looked solid until stress hit. Then the system had less room than people assumed. This is why the second horseman matters so much. It is not just about yields moving around on a screen. It is about the quality of the collateral base that supports short-term funding across the global system. If that base gets shaky, liquidity can disappear faster than most investors expect. So call it what it is. This is collateral stress. And when collateral stress shows up, the system gets fragile in a hurry. The third horseman is the US dollar. As the world's reserve currency, it sits at the center of global liquidity. When the dollar gets strong, global financial conditions tighten. That is not theory. That is how the system works. A stronger dollar makes dollar debt harder to service abroad. It pulls money toward US assets. It squeezes emerging markets. It makes refinancing harder for everyone sitting outside the core. That is one side of the story. But here is the catch. A weaker dollar is not automatically a clean escape route either. Because if the dollar weakens for the wrong reason, like a loss of confidence in U.S. fiscal discipline or doubts about the safety of the anchor itself, then you get a different sort of stress. You get trust erosion. You get repricing risk. You get a system asking whether the asset at the center is still as reliable as it used to be. So the world is caught in a bad setup. A strong dollar squeezes borrowers and drains liquidity abroad. A weak dollar can raise doubts about the anchor holding the whole structure together. That is why the dollar is a two-sided threat. One side is funding stress. The other side is confidence stress. And when you are already dealing with central bank runoff and fragile collateral, dollar swings hit even harder. Because global dollar credit outside the US is huge. That means dollar moves do not stay in foreign exchange markets. They run through debt servicing, funding costs, asset allocation, and liquidity conditions worldwide. This is where the market starts sorting story from structure. And structurally, the dollar remains one of the biggest pressure points in the system. The fourth horseman is the maturity wall. This is where everything comes together. The system is no longer mainly funding new investment. It is dealing with a giant wave of debt that has to be rolled over. That is the real story. And it gets worse because much of that debt was issued when rates were near zero. Now it comes due in a world with much higher funding costs. So the debt is not just large, it is coming back at a much uglier rate. That is where coupon shock comes in. A firm that borrowed at a very low rate suddenly has to roll that same debt at a far higher cost. That hits earnings. That hits margins. That hits survival for weaker balance sheets. And when enough firms face that at once, the whole market gets tighter. Liquidity that might have gone to new investment gets diverted into debt rollover. Capital gets more selective. The easy thesis starts to break down. This is why the maturity wall is not just a debt story. It is a liquidity story, a credit story, and a confidence story all at once. The more debt that comes due together, the more the system has to absorb. The more it has to absorb, the less slack remains. And the less slack remains, the more fragile everything becomes when stress hits. History gives us a clue here. Systems can carry large debt loads for a long time if liquidity is easy, collateral is trusted, and refinancing stays open. That is where the maturity wall turns from a data point into a genuine risk event. These four horsemen do not move alone. They feed each other. Central bank runoff reduces liquidity. Collateral stress weakens the funding base. Dollar swings raise pressure across borders. The maturity wall absorbs what liquidity is left. That is the setup. And that setup is more fragile than it looks. Make no mistake, this is not just a market wobble. This is not just a bond story. This is not just a central bank story. This is a system-level liquidity story. The world got used to easy money, deep collateral, and endless rollover. That old playbook is not working like it used to. The buffer is thinner, the margin for error is smaller, and the next move matters. So what should investors watch? Watch central bank balance sheets. Watch treasury market stress. Watch repo and haircut signals. Watch the dollar. And above all, watch the maturity wall. Because when a system stops funding the future and starts spending most of its strength carrying old obligations, that is when the strain becomes visible. Here is the bottom line. The hazard is not some mysterious shock no one could see. It is a slow building squeeze sitting in plain view. The signs are there. The pressure is building. And if these four horsemen keep moving together, the next phase will not be about comfort. History rhymes. Power rebrands. Stay inquisitive.